Most people think real estate makes money when homes rise in value. That is only part. Behind successful property deals is a system creating income, equity, appreciation, and sometimes tax benefits. You might buy one property, but several forces can quietly work on your wealth at once. Once you understand those forces, real estate starts looking more like a business than a house. First, there is money coming in every month, rent paid by people using your property. But rent is not profit. You still have taxes, insurance, repairs, vacancies, management, and mortgage costs. The real trick is what remains after expenses, because that leftover cash becomes your first engine. Now imagine your tenant helps cover a mortgage while you gradually own more property yourself. Every mortgage payment contains principal and interest, and principal reduces your loan balance over time. That reduction creates equity, the gap between property value and what you still owe today. Then comes appreciation, when your property becomes more valuable because the market changes around it. You don't control appreciation, but location, demand, development, and supply can influence property values. A property near jobs, schools, transportation, and growing businesses can attract stronger demand over time. When more people want homes than there are available properties, prices can face upward pressure. But appreciation is never guaranteed, because real estate markets can also fall when conditions change. Now we reach the part that makes real estate unusually powerful: leverage, or controlling an asset with borrowed money. Imagine buying a $200,000 property using $50,000 of your own money. The remaining purchase price comes from financing, meaning borrowed capital helps you control the entire property. If that property rises in value, your gain is measured against the equity you actually invested. That sounds powerful, but leverage works both ways, because losses can also become larger. Real estate becomes interesting when rent covers expenses and still leaves money behind each month. Suppose your property collects $2,000 monthly. That does not mean you earned $2,000. Property taxes, insurance, maintenance, utilities, and management can quietly consume a significant portion. And there is another expense many beginners forget: vacancy, when nobody is paying rent. One empty month can reduce your annual income, especially when your mortgage payment continues anyway. That is why experienced investors keep cash reserves instead of spending every dollar immediately. Because eventually something breaks: a roof, appliance, pipe, air conditioner, or electrical system. The smart investor calculates profit after realistic expenses, not based on rent alone. And here is where the story gets interesting. Cash flow is only one way property can build wealth. Think of real estate as four engines working together: income, equity, appreciation, and potential tax advantages. Real estate can also have tax advantages, although the rules are more complicated than most social media videos suggest. One major concept is depreciation, which can recognize the property's cost over a long recovery period. Depreciation is different from a cash expense, which is why understanding accounting matters for property investors. But tax benefits depend on your situation, property type, usage, and current tax rules. A smart investor should never buy a bad property simply because someone promises a tax deduction. The property still needs sensible numbers, manageable risk, strong demand, and a realistic path toward profitability. This is where homeowners and investors can think differently about the same property. A homeowner may focus on comfort, neighborhood quality, schools, and personal lifestyle. An investor asks different questions: rent, expenses, vacancy, financing, demand, and potential return. And sometimes the most beautiful property is financially weaker than the boring one next door. Once the property makes sense, the next question becomes how you finance the purchase. A larger down payment can reduce borrowing, while a smaller one can preserve more cash. Neither choice is automatically better. It depends on cash reserves, financing costs, risk, and investment goals. Remember, borrowed money is never free. Interest becomes part of the property's long-term cost. A higher interest rate can shrink monthly cash flow and change whether the deal actually works. Here is another concept investors watch closely: return on equity, or what your existing equity produces. Over time, mortgage paydown and appreciation can increase the amount of equity you control. But growing equity does not automatically mean you have spendable cash sitting inside your bank account. To access that equity, investors may consider selling, refinancing, or other financing strategies. But accessing equity through debt can increase payments and risk, so leverage must always be handled carefully. Buying property is one thing, managing tenants, repairs, payments, and problems is something completely different. Your time has value too, and that cost is often ignored when calculating real estate profits. Some investors hire property managers to handle daily operations, but that service comes with another expense. The trade-off is simple: spend money to save time or keep money while doing more work yourself. Once investors understand one property, they may eventually consider adding another property to the portfolio. The goal is not simply owning more houses, it is repeating a system that produces sustainable results. But every additional property also adds more loans, tenants, repairs, paperwork, and potential problems. Scaling can increase wealth, but it can also increase exposure when markets or personal finances turn against you. That is why some investors diversify across locations, property types, tenants, and other investments. Real estate is powerful, but it is not magic, and every advantage comes with a corresponding cost. Real estate does not move upward forever. Markets expand, slow down, decline, and eventually recover. When interest rates rise, borrowing becomes more expensive, which can change what buyers can afford. Higher monthly payments can reduce purchasing power, putting pressure on property prices and transaction activity. When borrowing costs fall, more buyers may qualify, potentially increasing competition for desirable properties. That means the same house can produce completely different financial results under different market conditions. One of the biggest beginner mistakes is falling in love with a property before studying the numbers. Experienced investors often start with numbers, then decide whether the property deserves their attention. They estimate income, operating expenses, financing costs, vacancy, repairs, and expected returns before making decisions. Then they ask an uncomfortable question: what happens if everything goes worse than expected? A strong deal should have enough breathing room to survive ordinary surprises without immediately becoming a financial disaster. Sometimes the biggest advantage comes before ownership, when an investor finds a property at the right price. Buying too high can destroy returns, even when the property itself looks attractive. That is why negotiation matters, especially when sellers have reasons to move quickly. Investors can also create value by improving properties, increasing rent, reducing waste, or solving operational problems. A smart renovation does not mean making everything luxurious, it means spending where improvements actually matter. Better layouts, reliable maintenance, and desirable features can sometimes help attract stronger tenants. Sometimes small changes create meaningful results because tenants care about convenience, safety, cleanliness, and reliability. But over-improving can waste capital when renters or buyers will not pay enough to justify it. The goal is not the fanciest property. The goal is creating value relative to what you spend. So now the formula becomes clearer: buy intelligently, operate efficiently, build equity, and manage risk. A property can look profitable on paper, but the wrong tenant can quickly turn that calculation upside down. Reliable tenants can reduce turnover, missed payments, unexpected damage, and the constant cost of finding replacements. That makes careful tenant screening an important part of protecting the investment. And remember, even excellent management cannot completely rescue a property in a weak location. Real estate investors often think in years, not weeks, because property wealth usually develops gradually. Over long periods, rent, equity, appreciation, and reinvestment can potentially reinforce each other. Instead of spending every dollar of cash flow, some investors reinvest profits into improvements or future opportunities. Eventually, multiple properties can create a portfolio where several assets contribute to the overall financial picture. However, owning several properties does not eliminate risk, especially when the same market affects them all. That is why successful real estate strategy is less about one perfect property and more about managing an entire system. At some point, investors must decide whether to keep the property, sell it, or change the strategy. Selling can turn property equity into cash, giving investors capital for other opportunities. However, selling is not free because commissions, closing costs, repairs, and taxes can reduce the final proceeds. If the property has appreciated, the taxable gain can become an important part of the selling calculation. Tax treatment can depend on ownership structure, use, holding period, and other specific circumstances. A property can appear highly profitable until you subtract every cost required to actually complete the transaction. That is why selling should usually be a strategic decision, not simply a reaction to short-term market excitement. Sometimes holding longer makes sense, other times selling and reallocating capital can create better opportunities. This introduces another powerful idea: opportunity cost, or what your money could potentially earn elsewhere. The real question is not whether your property made money, but whether your capital worked efficiently. Real estate wealth is not simply the number of houses you own on paper. What matters more is the relationship between your assets, liabilities, cash flow, and overall net worth. Debt can help investors control larger assets, but only when the payments remain manageable. Too much debt can turn a promising investment into a serious financial burden very quickly. That is why liquidity matters. Valuable property does not always mean immediately available cash. Cash reserves provide breathing room when vacancies, repairs, emergencies, or unexpected expenses suddenly appear. Strong investors usually avoid building a portfolio that requires perfect conditions every single month. Surviving difficult periods gives investors time to benefit when markets eventually improve again. For some people, the long-term goal is eventually generating enough income to reduce dependence on employment. However, financial freedom through real estate usually requires patience, capital, discipline, and years of consistent management. Real estate is often called passive income, but owning property can involve plenty of active work. Even with a property manager, owners still carry financial, legal, and market-related responsibilities. Another reason investors consider real estate is inflation, which can change the value of money over time. Over long periods, rents may rise as wages, prices, demand, and local conditions change. But inflation can also increase repairs, insurance, taxes, labor, and other ownership costs. So inflation can help some parts of the equation while simultaneously hurting others. The biggest advantage may actually be boring, consistently owning a productive asset for many years. Time allows mortgage balances to decline, rents to change, and property values potentially to compound. That is very different from trying to get rich quickly by guessing the next hot neighborhood. The real secret of real estate may be less about predicting tomorrow and more about building something durable. Before buying anything, understand the property's income, expenses, financing, risks, and realistic expected returns. Then study the local market: jobs, population, rents, inventory, development, and neighborhood demand. Next, choose financing that leaves enough breathing room when rates, repairs, or vacancies become unexpectedly expensive. Keep reserves separate from your everyday spending because properties rarely behave perfectly every month. Good investors watch expenses closely because small recurring costs can quietly become thousands over several years. Think like an owner, not a speculator, and focus on the property's underlying economics. If everyone is talking about one neighborhood, that excitement may already be reflected in today's prices. Your advantage might come from better research, negotiation, management, financing, or simply having more patience. There is rarely a perfect property. There are only properties whose risks and rewards fit your strategy. And now you can see why real estate creates wealth through several connected mechanisms working together over time. The first major mistake is buying based on emotion instead of understanding the numbers. The second mistake is assuming rent will always rise while expenses somehow stay perfectly flat. Another mistake is using too much leverage because rising property values make debt feel harmless. Another is ignoring maintenance until a small problem becomes an expensive emergency. And perhaps the most dangerous mistake is assuming real estate prices can only move upward. Markets can fall, vacancies can increase, borrowing costs can rise, and properties can require unexpected repairs. The investors who survive those periods usually prepared before the difficult period actually arrived. Your investment should not require perfect tenants, perfect markets, perfect rates, and perfect timing to survive. Real estate wealth is usually built through repeated reasonable decisions, not one unbelievable home run. The mindset changes from chasing quick profits to building durable wealth through disciplined ownership. So let's put everything together. Real estate can create wealth through income, equity, appreciation, and smart financing. But the property itself is only the starting point. The real engine is how everything around it works. Rent can create cash flow, but only after accounting for every realistic operating and financing expense. Mortgage paydown can gradually increase equity, giving owners a larger financial stake in the property. Appreciation can increase property value, although nobody can guarantee exactly when or how much. Leverage allows investors to control larger assets, but it also magnifies the consequences when investments move against them. The real advantage is not one trick, it is having several wealth-building mechanisms working simultaneously. And that is why successful real estate investing often looks boring from the outside but powerful over decades. You do not need every property to become a home run, you need a system that survives. Because real estate does not create wealth through magic, it creates wealth when disciplined decisions compound over time.